we've done a lot of talking over the last day, and we'll do a lot more discussing around supply chains. A lot of it has been around the short term, around geopolitics, around various crises that we've seen over the last few years. But there's one area where this is going to remain front and center for years to come, and that's energy, and that's clean energy more specifically. This is a facility that's owned and operated by CATL. It's the world's biggest battery maker. This is a facility that's located in China, and in many ways it's a vision of the past. It's a vision and encapsulates sort of decades of targeted investment, of technology transfer, of supply-side, demand-side incentives, and really targeted industrial policy. And it's really facilities like these that have provided the backbone, economically speaking, for the energy transition, the proposition that it offers today, and the rocketing decline in costs that we've seen for solar, that we've seen for batteries. So those highly efficient, integrated value chains that we have today also have a flip side, and that's one of extreme concentration. So you can see here, this is where capacity is located as of for most of these sectors, August 2022. And when we look across the parts of the value chain that are so vital for batteries, that are so vital for solar, the share that's located in China is over 70% for 11 of those. And that is seen by some as a bit of a vulnerability. It's enabled those cost declines. That's been vital and is incredibly important. But at the same time, having so much polysilicon concentrated in just a few Chinese provinces mean that, like in August of last year, when you have droughts and a power crisis, prices go up and the cost of solar goes up too. So we saw polysilicon prices reach 11-year highs in August of last year, and that had a big impact on developing solar projects globally. There's a big increase currently in the amount of investment that's going into building supply chains, building out supply chains and manufacturing factories in clean tech. And this is showing all the different sort of subsectors too that we saw in the last slide. And while this is a small fraction of spending compared to the over 1 trillion that was spent on the energy transition last year, it's a fraction and a share that's growing steadily and quadrupled over 4 years to reach around 79 billion in 2022. And that spending's ratcheting up, but what's also increased is the share of new facilities by their capex, so this is by their investment associated with those facilities that came online in the year that's shown, that's in China. So 96% of new solar factories for polysilicon, ingots, wafers, cells, modules came online in that country. And the share for the energy transition writ large is above 90% for new facilities across the board. So we've seen all this talk about nearshoring, about onshoring, about friendshoring, about localization. But right now what we're not seeing is a real shift in terms of new factories and where they're coming online. Could that change? Well, there's the vulnerability picture. That's something people want to reduce this concentration. There's also a political imperative, a perceived one, to create jobs, to accrue value locally. That's at the heart of the Inflation Reduction Act that was enacted in August of last year. So Joe Biden set out over 360 billion of spending over the next 10 years is what's estimated. In effect, because these are tax credits, they're uncapped, it could be far in excess of that figure. You could be seeing, according to certain estimates, even double that spending over that period. It's a lot of money. And a lot of that money is going into deploying technologies like solar, wind, carbon capture and storage, hydrogen, electrolyzers. It's also going into R&D spending to push the technological frontier, and it's also going into manufacturing. So many incentives are offered across the board with all of these production and investment tax credits that are being offered by IRA, but these ones are only valid if you're building in the US. So they're highly targeted, they make up a large share of production costs for the most part, and they target really every important bit of the value chain for some vital clean technologies, everything from wind turbines to batteries to bits of solar going well upstream. And that's had an impact. Investors have taken the bait. What we've seen since is a wave of announcements, just like we've seen for semiconductors after the CHIPS Act, after IRA, we've seen a wave of new announcements for new battery and EV production facilities, topping 57 billion since August, and those are new facilities that have been planned across North America, but much of that's concentrated in the US. Europe wants to do something similar. So the EU has also staked out its plan to build out, so not just with recent days we've seen the enactment of some important provisions as part of the Fit for 55 package, which is the EU's driving climate package. We've also seen really mapped out sort of the ambitions that the EU has in terms of accruing local value for things like batteries. And on the face of it, it's looking pretty good. You can see demand for batteries coming from EVs, from stationary energy storage, for example, well in excess of proposed targets, well in excess of demand when you look at battery cell facilities that are planned. But these are just announcements. These aren't projects that have reached FID. And increasingly, that pipeline is looking brittle. And one of the reasons is because of concerns around the impact of IRA, the impact of the Inflation Reduction Act, the fact that those incentives offered stateside appear far more generous and easy to access than what's being offered in Europe. You've seen a number of EV makers, battery makers, Tesla, Northvolt to name two, come out, make announcements that maybe they're delaying investments in facilities in Germany, for example, or maybe shifting and pivoting towards the US in terms of plans for expansion. So that's led to a response. There's been immense pressure on the European Commission to come up with something convincing. What it came up with a few weeks ago was the Net Zero Industry Act. This is a piece of proposed legislation that sets out targets that are very ambitious, as you can see here. They imply vast growth for several industries, and even in the ones where mature supply chains are mature, like for wind, that growth is considerable. And our projections of what's being planned for wind turbine nacelle blade factories is actually we see a bit of a shortfall with meeting those targets today. So there's a lot to be done, not to mention building a solar value chain pretty much from scratch in the EU. But there are certain things, and one of them is that this is a piece of proposed legislation. These aren't official targets yet. The EU process takes about a year or two to get through before anything gets passed into law. That's in stark contrast with IRA, that came in far faster than what was expected and set a lodestar for the US to act. Also, and there's various ways of picking apart this piece of legislation, another is that what's proposed today is quite vague in terms of what bits exactly of the value chain are covered. That's not the best signal for investors. And when you look at new funding that's specifically targeting manufacturing as part of this, you end up with a big fat zero. So there's vast amounts of grant funding that's available for manufacturers in the EU, and those are really substantial and make up a considerable, well, can really rival what's being offered by the US. But in terms of specific incentives, when you look across the Innovation Fund, the Modernisation Fund, the Next Generation EU Fund, we actually fall quite short in terms of specific funding for manufacturers, and that's not been changed even with talk of a sovereignty fund, which will target a number of sectors across semiconductors as well as clean energy. And accessing that funding is difficult. Even in the specific pots of money like the Innovation Fund, the rate of success of proposals that are take a lot of time to put together is extremely low. It's extremely competitive, it's cumbersome to access. It doesn't make things easy for accessing that money. And that's important because those subsidies are to make up a shortfall, a big delta, a difference in costs when it comes to building out factories. You can see there, fourfold is sort of the cost of what we estimate it costs to build solar factories across the value chain for a gigawatt per year rated, shown here. When you compare to China and Southeast Asia, that's a big difference. But that also can be seen relative to deployment costs, and some assumptions are shown here for those numbers, but without getting too bogged down in it, that factory spending to meet those European targets is actually quite small when you compare it to the cost of the energy transition overall, which is about 7 times more. And that's not even for a net zero scenario, that's just for a scenario where you're meeting demand at lowest cost. But there's a flip side again, there's always a flip side, and that's that deployment costs will be impacted by building locally. So these are prices for battery packs that we've surveyed. The middle lines are weighted averages, and you can see that Chinese battery packs are about a third less expensive than those that are sold and made and sold in the EU in North America. And then we can start to look at the impact on deployment, and we can start to think about, with different levels of local content, if we're meeting EU battery storage demand locally from local production, then we can start to think about the impact between different scenarios if we're relying on Chinese batteries or a mix of European and Chinese. For battery cells, that difference, and this is just for battery cells, we're not talking about anodes and cathodes and separators and electrolytes, which would boost this cost. Just for battery cells, that would increase the yearly deployment cost in 2030 by nearly $12 billion. So if we add on that bit of funding, that extra cost to deployment, then you start to get a measure of the scale of the impact that localizing things represent. So I've been talking about visions of the past, of the present. This is a vision of the future. We're going to see increasing spending on supply chains, and there are many constraints to this beyond just cost. There are material constraints, there's skills, there's know-how. Transfer of technology is not as fluid as it used to be. So there's a lot of challenges, but we really need to get the costs down and understand the economics of this. And that way we can begin to chart out supply chains for clean tech that are not just diversified, that are not just resilient, but are fit for net zero purpose. Thank you.